Hi, everybody. Welcome, and thank you for joining us for our 2025 tax updates. We're going to go over all the updates for the 2025 filing year. Happy to have you guys here. It's going to be a really great, really informative webinar this evening. This one is always one of our most popular, one of our most highly requested webinars every year. So we are super excited to bring you all of this tax information, especially with all the changes that are going on right now. This is a very important, very helpful webinar that we are very, very excited to deliver all of you guys today. Just a quick note before we introduce our guest speaker. It is just me here manning chat and Q&A. So what we're going to try to do is save about 10 minutes or so at the end of the presentation for a designated Q&A portion. Anybody who has questions as the presentation goes on, make sure you actually use that Q&A feature, not the chat feature. Q&A is where you can drop your questions. At the end of the presentation, when we have that 10 minutes, I will go through and see which ones we can get to actually in person today on the webinar. Any that we cannot reach out for you guys today, or if there's any questions that go unanswered, just go ahead and let us know by sending an email. We will have an email that I'll drop in the chat. Actually do that right now. Let me go to our chat. There we go. So I will send you this information as the sound goes on. I also see someone maybe mentioned that the sound was off. Is everybody able to hear me all right? You guys could just let me know in the chat. Okay, perfect. Yeah, so any questions, like I said, we don't answer, I will make sure we point you in the direction of somebody who is able to answer those questions for you at the end. At the end of every presentation, we are also going to probably tomorrow or Friday pull 3 names to give a $25 Amazon gift card for. So check your email for that. We should have those emails sent to you guys on Friday. If you do get an email from Patelco Credit Union webinar saying that you've won, it is not spam, it is us. We are actually giving you guys a $25 gift card. And like I said, just the people who are going to be chosen for the raffle will get the email. So keep your eyes peeled for that sometime on Friday. And at the end of the webinars, we've been saying this, but we will also be having a short survey for you guys to fill out. If you wouldn't mind sticking around for just a minute or so when the webinar's over, answering a few questions, it would be greatly, greatly appreciated by us. But for today's webinar, you can use chat, like I said, for just like sharing stories and things like that. But questions, make sure you use that Q&A feature. We will try to get to as many as we can at the end of this. But there will probably inevitably some we're not able to get to. So we will just have you guys use the information that I sent in the chat previously for that. All right, so for today's webinar, brief introduction here. Tax laws change every year. Staying informed can make a very meaningful difference when it comes to filing confidently and maximizing your tax return. So this webinar today is going to break down all of the important updates for the 2025 filing year so you guys can feel prepared, informed, and in control. We have got our wonderful guest speaker here. He has delivered our tax webinar every year. He is a great guest of ours, Timothy Roscoe Carter. He is a qualified tax expert with the Low Income Taxpayer Clinic at the Justice and Diversity Center of the Bar Association of San Francisco. He is an expert. He knows his stuff. I'm very excited to retain some of this information myself. So with all of that said, Timothy, welcome, and please take it away.
Thank you, Andrew. Thank you very much, and thank you for having me, and thank you for all the people joining. I'm always glad to do this one, and you promote it very well. So let me get the slideshow going here, and there. So can everybody see it now? Okay. All right, so this is the update for going for the things that affect the taxes that you're filing now for 2025, and giving you information going forward for 2026. And Andrew just went over who I am and where I'm from. Let's see here. The Low Income Taxpayer Clinic this is a national organization it's a national network of clinics that are funded by grants, matching grants through the National Taxpayers Office, which is a semi-independent branch of the IRS. We provide free representation to low-income taxpayers before the Internal Revenue Service in audits, appeals, collections, and before federal courts in matters of tax litigation. We also provide advice and counsel, so we can provide free legal consultations, confidential legal consultations to anyone, regardless of their income, on matters of income taxes. We receive matching funds from the IRS, but we are completely independent of and not associated with the federal government. It is in fact our job to fight the federal government on behalf of taxpayers. And each clinic independently determines whether we believe that somebody meets our income criteria, as well as whether or not we think they have a case to spend our time on. In addition to the representation, there's two other things that we do. We advocate for low-income taxpayers on issues that are particularly important to them, and we educate taxpayers about their rights and responsibilities. And that's what I'm doing here today in conjunction with the credit union. So this year, the vast majority of changes that affect people come out of the One Big Beautiful Bill Act that was signed in the middle of the year. The four big things that most people are concerned of with the individuals that affect their tax, the way the OBBBA affects their taxes, the no tax on tips provision, the no tax on overtime, the no tax on car loan interest, and the enhanced deduction for seniors. You'll see as I go through here why I put some of this in quotations. These, unlike a lot of the things in the OBBBA, all four of these are new deductions for individuals, but they are all for 2025 through 2028 only. So they are set. A lot of the things in the OBBBA are permanent, but these four deductions are set to expire after 2028. One good thing about them is that they are for both itemizers and non-itemizers. So regardless of whether or not you generally itemize your deductions, you will be able to take advantage of these if you otherwise meet the criteria. The no tax on tips provision, this refers only to tips that are paid voluntarily in amounts determined by the customer, and only for occupations that the IRS has determined regularly and customarily received tips before January 1st of 2025. So there had been talk before this about, not about like paying your lawyer and calling it a tip. But that's not a thing. They listed about 60. The IRS has a list of I think it's 68 occupations in 8 categories that are eligible for this, that they identified generally receive tips before the beginning of last year, and the tips do have to be voluntary. So if you go to if you go to a restaurant and they add on a service fee that's automatic, then that does not, even if that service fee is then distributed entirely to the wait staff, it is not. It doesn't qualify for this deduction for the waiters. It has to be a completely voluntary tip. There are a good many limitations. The maximum deduction is $25,000. There are phase outs that begin for people who make more than $150,000 or $300,000 for married filing joint. You have to have a valid Social Security number to receive it. You have to report all of your tips to receive it. And so you report all your tips and then you take the deduction. You cannot receive this if you file married filing separately. And even though it says no tax on tips, the tips are still subject to Social Security, Medicare, and self-employment taxes. And they are still subject to California income taxes. The next provision, no tax on overtime. This applies to extra pay that's required for overtime work under the Fair Labor Standards Act, which is time and a half for all work performed beyond 40 hours a week. This one is also subject to a lot of limitations. The maximum deduction is $12,500 or $25,000 for married filing joint couples. The phase outs also begin at $150,000 or $300,000 for married filing joint. You have to have a valid Social Security number. You cannot file married filing separately. And and again, even though it says it's called no tax on overtime, the overtime pay is still subject to Social Security, Medicare, and self-employment taxes. And it's also still subject to California taxes. So an example, to just show an example here for this one, because this one seemed a little more complicated than the others. Let's take somebody who's in a skilled job and they have a union contract here. They're generally making about $30 an hour. They work 2,000 hours. So their regular pay for the year, let's say for 2025 was $60,000. And they generally worked about 10 hours of overtime every week. So that gives them, they had 500 hours during the year of overtime. So that's time and a half at $45 an hour, giving them 22,500 in regular overtime. And then they had $60 an hour because about once a month or a little more, they were able to work Sundays or holidays, and under their union contract, they get double time for those particular types of overtime. So that's an extra 100 hours that they worked for $60 an hour. So that's $6,000 they received in double time. Now, if you look at this person, their income for the year was $88,500. Their total pay from overtime hours, that is all of the 600 hours that they worked overtime, was $28,500. Their total overtime pay, that is all of the pay that they received above the regular $30 an hour, was $10,500. But and then you have the total pay that was required, overtime pay that was required under the Fair Labor Standards Act, which is the extra 1/2 over the normal for 600 hours. So that was $9,000. So the question here is, what is the deduction that this person gets from their income for the no tax on overtime provision? And the answer is the $9,000 from the that's the required overtime pay. Again, they don't get the deduction for the normal pay during overtime. So they don't get the deduction for the $30 an hour they were normally going to get paid, and they only get the extra one half. And even though their union contract gives them double time, that's not required under the Fair Labor Standards Act. So they're still only getting the one half. So they get the one half, that's $15 an hour for 600 hours, which is 9,000, and that's their deduction. And that is still less than the maximum deduction of 12,500. So they do get the full 9,000. Going on to the next one, no tax on car loan interest. So this is a provision similar to the mortgage interest deduction that people get on their homes. It applies to interest on loans used to purchase automobiles for personal use, so it's not business. And by personal use, it means that you expect that the car will be used more than half of the time for personal use by you or a person with whom you have a relationship. Your spouse, your child, another relative, a close friend, someone like that. Going through the many limitations on the no tax on car loan interest, it is a maximum deduction of $10,000. The phase outs on this one begin at $100,000 or $200,000 for married filing joint. You must have a valid Social Security number. It's only for new vehicles, so you can't get it for buying a used vehicle. The final assembly of the vehicle must have been in the United States. It could be made of parts that were manufactured all over the world, but the last place they were put together has to have been the US. The loan must be secured by the vehicle. Again, that's similar to the mortgage interest provisions for your house. The loan cannot be from a related party, and the loan must have originated after the end of 2024. So that means during the loan was began in 2025 to get the deduction for 2025. Car must have at least two wheels, so you can use this for buying a motorcycle, and it must weigh less than 14,000 pounds. So no really big trucks. I don't really know how big something has to be generally to be over 14,000, but it's pretty big there. You have to list your vehicle's vehicle identification number, the VIN, on the tax form. So you have to have that. And you cannot use the vehicle for salvage, scrap, or for parts, something that you're driving around for personal use. And then finally here we have the of these four main new deduction provisions for individuals. We have the enhanced deduction for seniors, which is an extra $6,000 for each taxpayer who is age 65 or over. And it can be for either or both people in a married couple, as just if only one of them's over 65, then you get one of the extra deduction, 6,000 deduction. If they're both over 65, then you can have a $12,000 deduction. Phase outs, there are phase outs for this as well, beginning at 75,000, which is 100 or 150,000 for married filing joint. Anyone who takes it must have a valid Social Security number. You cannot take it if you file married filing separately. And it should be noted here that it does not affect taxability of Social Security. I'm putting that in here because this is what evolved out of Trump's original proposal, I'll call it, during his campaign for eliminating taxes on Social Security. This does not actually affect the taxability of Social Security. And most people, in fact, most people who are eligible for this probably have either none of their Social Security is taxable or only very little of it. In fact, at 65, not everybody's getting Social Security, so this is available to a lot of people who don't even get Social Security. And then most people who do pay taxes on their Social Security are getting over the phase outs. So it evolved out of that campaign proposal, but it's not really related to your Social Security income. So there are a lot of provisions in the OBBBA affecting the taxes for individuals beyond those four new deductions. The first is go over some here for homeowners. There's the $750,000 limit on the home mortgage interest deduction. This was put into place as part of the Tax Cut and Jobs Act, which was passed during the first Trump administration, and it was scheduled to expire and revert back to allowing up to $1 million of home mortgage interest. But now it has been made permanent. So that limitation has been made permanent. It is if you're filing separately, the limit is half, so 375,000. There are people. This is for mortgages that were these are for new mortgages. However, people who took out home mortgage loans prior to December 16th of 2017 can still take a mortgage interest deduction of up to $1 million. One good thing new for homeowners is that private mortgage insurance premiums are now deductible. This is especially useful for people, excuse me, for people who took out new loans, and generally you have to have private mortgage insurance if you don't have a down payment of at least 20% of the home value, and so people who are in that situation, they can deduct the private mortgage insurance as part of their mortgage interest deduction. Also useful, very useful to homeowners is the temporary increase in the state and local tax deduction, sometimes known as the SALT deduction, which had been limited in the Tax Cut and Jobs Act to $10,000. And this affects particularly property taxes are a big one in here. It has gone up to, it has been raised to $40,000, but that's one provision that is set to expire. So this is for the years 2025 through 2029. After 2029, without further congressional action, that will reverse back down to 10,000. There are a lot of provisions for energy tax credits that had been put in place during the Biden administration that had been scheduled to last quite a while. The OBBBA has terminated most of them. One big one has to do with the credit for clean vehicles. There were two different provisions here. One is the credit for the clean credit for new vehicles, and the one for used vehicles. Those were terminated for purchases as of September 30th, 2025. So if you purchased a new or used clean vehicle prior to September 30th, well, on or before September 30th of 2025, so before October 1st, then you can still take that on your 2025 taxes. But if you bought it after September 30th, you cannot. And so the new clean vehicle credit is up to $7,500. The used credit is up to $4,000. This one also has caps on sales prices, income limits, and they have to meet certain standards to be considered to be clean vehicles, clean energy vehicles. The and what it means to have purchased the vehicle means that there has to have been a binding contract and at least a nominal deposit. So at least one payment must have been made by September 30th of 2025. Even if the vehicle may have been delivered after that date, or you may have taken possession of it before that, but if you haven't signed the contract and made a payment, then you can't. So it's when you sign the contract and made the payment that's important, not when you actually took possession of the vehicle. Also, there was a credit for the EV charging credit. This is for setting up EV charging in your home. There was a maximum credit rate of 30% with a maximum for $1,000. This is technically still around, but only for a few months. It's been terminated for property that's placed into service after June 30th, 2026. So if you're planning to set up a EV charging, if you're planning to set up EV charging equipment in your home, do so now. Within the next 3 months or so, make sure you get it done, get this installed by June 30th, 2026, to make sure that you can take the credit for 2026 on your when you file this year's taxes a year from now. If you did this in 2025, you can still, anytime in 2025, you can still take this credit. There were also credits that were available that had been available for home improvements, for making your home more energy efficient. There was a residential clean energy credit for things like solar electric systems, solar water heating systems, small wind energy systems, a geothermal heat pump system, and for having battery storage or for fuel cell property. That was a 30% credit rate with no dollar cap limit. And then there was another general home improvement credit, again, for energy efficiency. And that included for insulation, air sealing, weatherization, exterior windows, central air conditioning, heat pumps, biomass stoves and boilers, and home energy audits. There's some, that was also 30% credit with a general annual cap of $1,200. And there are other caps depending upon specific improvements. So for a lot of energy property, the cap was $600. For heat pumps, it was $2,000. And then for energy audits, it was up to $150. You can still take those if you did if you did any of these improvements to your home in 2025. You can still take them on your taxes that you're preparing this year for last year. However, all of the installation, it must have been completed, and the improvement must have been placed into service by the end of 2025. If you did it afterwards, or if you plan to do it now, probably a good idea, but you won't be receiving any tax credits for it. So this is a summary here. So the dates to remember on terms of the elimination of these energy credits, one is September 30th of last year, and that's for the credit for clean new vehicles, new and used vehicles. Another deadline to remember was the end of the year 2025. That's for clean energy home improvements. And then the other deadline to remember is June 30th of this year, which is the only upcoming deadline, and that's for EV charging stations in your home. So that's something to get done now if you if you plan to do that. Okay, so there's also been not really changes, but changes to changes here for a reporting form known as the 1099-K. And I'm bringing this up that you'll see in a moment I'm bringing this up because this is something that a lot of people heard about over the past couple of years and have been worried about. And so to let you know what the 1099-K is, it's an information reporting form. So like the 1099 miscellaneous, 1099 NEC, or that you receive for getting receiving non-employee compensation. If you received interest, you get a 1099 INT, dividends 1099D. In the information forms, and when you're a worker, you get an employee, you get a W-2 at the end of the year. These are information forms that the payers send out to the payee and to the IRS. So you get a copy and the IRS gets a copy. And for 1099-Ks, these are issued by third-party electronic payers to the payees and the IRS. And so a third-party electronic payer is like credit card companies, PayPal, Venmo, anything like that, where they pay out money. And these are and this is for business transactions. I'm not going to go into what all of the changes were. There were a lot of changes there was one big change that was coming to the 1099-K reporting rules. Then that had a lot of people upset and sort of scared. And then the IRS had a very complicated and long process for how they were going to phase the rules in. But you don't need to worry about all of that because the OBBBA reverted everything back to the old rule. So you just need to know the old rule, and that is that the 1099-K is the electronic reporting company, electronic payer company is required to report if the recipient, if the payee had received at least $200,000 and they received at least 200 minimum payments, and it had to be both. It had to be over at least 200 payments, and the total had to be over $20,000. So if you received 5 payments of $5,000 each, then you went over the minimum amount of money, but you didn't go over but you only had 5 transactions. So then the Venmo or whoever would not have a requirement to report this to the IRS. Likewise, you're online and you had something going on online and you had like 400 people paying you $2 each. You went over the $200 minimum payment, but the total was only $800. They're not, so that then the Venmo or whoever, they're not required to report it. It has to be, you have to have gone over both of these minimums to trigger a requirement for the 1099-K. Something to keep in mind about this, however, a lot of people were worried about how this would change their actual taxes. And it doesn't. Even the new rules, if had the new rules gone into effect, that wouldn't have changed people's actual taxes. It only affected what was being reported. So it has no effect on your tax liability. So if you're the person who did the 400 transactions, and because you have an online store or something, and you got more than $800, and you didn't have very many expenses to that, and so you had a net self-employment income of over $400 only because of this. You still have to report that on your tax return, because that's over $400 of self-employment income. Even though the payment company is not required to report it to the IRS, you still are if it's self-employment income. Or for whatever reason you got it, if it's income and taxable, and you goes over a filing requirement, you have to report it, whether or not the payor had reported it to you or the IRS. And then the other thing to remember is that they also have to send out a 1099-K if they're required to, if any backup holding is required. That means for instance, if Venmo or the credit card company or whomever has been told by the IRS to send a certain portion of any payments they make to you, send those to the IRS, then they have to file a 1099-K, regardless of how much. Even if they only sent you $100, they withheld some of it and send it to the IRS because of a backup withholding requirement, then they still have to file 1099-K and submit it to both you and the IRS. A bunch of other aspects here about things that happened with the OBBBA, which is that they made a lot of items from the original Tax Cut and Jobs Act permanent, even though there were a lot of them that were set to expire at the end of 2025. So and some of the big ones here is that the personal exemption was eliminated. That is a certain amount of money that was, like if you have a dependent, you get certain deductions. There was a deduction for for each person and that was eliminated. And that's been made permanent. That's sort of counterbalanced by a nearly doubling of the standard deduction. The standard deduction doubling that doesn't exactly make up for the personal exemption, because doubling the standard deduction eliminated some people who could have itemized if they hadn't done that. So some people were in a position where they could take the standard deduction, and because it's less than the itemized deductions, they could still take the itemized deductions as well as the standard, and then still get the personal exemption. But now they can't do that, because if the standard deduction that's been doubled with the elimination of the personal exemption, it may make them not able to take itemized deductions. Kind of complicated, but it just depends was your situation as to whether you're better off or not because of the elimination of the personal exemption. Another thing that's been made permanent is the qualified business income deduction. It remains available for pass-through business owners, and that was going to be eliminated. The lower marginal tax rates. So a lot of these rates were the Tax Cut and Jobs Act had reduced a lot of the tax rates, and those were set to go up at the end of 2025. In particular, the 12% rate was going to go up to 15%. Several of those in the middle were going to go up a few percentage points. And then the top rate was going to go up from 37% to 39.5%. But those raises have been eliminated, and these lower rates have remained permanent. The casualty and theft loss rules. So the Tax Cut and Jobs Act eliminated basically all casualty and theft losses for personal property. So that deduction had been eliminated, and that elimination has been made permanent, with the exception that there was an exception to this that came about during COVID for personal casualty losses that directly result from federally declared disasters. I had hoped this would be the first year I didn't have to say the word COVID, but there it is. But that deduction itself has been made permanent. And then finally, the Tax Cut and Jobs Act eliminated miscellaneous personal deductions. So the big ones there tended to be things like your union dues, unreimbursed job expenses, your deduction for paying a tax preparer to prepare your taxes. Those kind of miscellaneous itemized expenses used to be deductible if they went over 2% of your income. They are but that was eliminated by the Tax Cut and Jobs Act, and that elimination has been made permanent. There is one exception to that. There's a small deduction for unreimbursed expenses to teachers that is still available. But other than that, most miscellaneous itemized deductions have been permanently eliminated under the OB. Going through here, a little discussion about who benefits from the OBBBA. There's overall, people in the bottom 20% are worse off. They get a few benefits, tax benefits from the One Big Beautiful Bill Act, but they don't get a lot of them because they weren't paying they weren't really paying much taxes to begin, federal income taxes to begin with, and those, so that they benefit a little but not much, and then they all of the but the a lot of the cuts to social programs hit them especially hard. So the spending cuts hit them especially hard, and so they're after you take that into account, their income of the people at the bottom 20% has been lowered by an average of just over 3% of their income. The working class households are receiving modest, receiving, let's say 20 to the 40th percentile, receiving modest benefits from this legislation, modest temporary benefits, primarily because of the four new deductions that we that we discussed earlier, including the no tax on tips and the no tax on overtime, as well as an increase in the child tax credit, where it went up from $2,000 to $2,200, and more importantly, has been indexed for inflation. So those are modest benefits, but most of these, well, particularly the four that I mentioned before, the no tax on tips and overtime, as well as the senior deduction and the deduction for car loan interest, those are all going to expire, so they're only there for 4 years. For people in the 40th to 80th percentile range, they're set to gain probably about $500 to $1,000. They're the ones who generally benefit from the car loan interest deduction, the senior deduction, the expansion of the SALT deduction, and the permanent tax rate reduction that all of which we discussed earlier. 60% of the benefits, of the tax benefits from the One Big Beautiful Bill Act go to the top 25% of earners, with the top 10% set to have to gain 2.7% in income rise because of it, or at least around roughly around $12,000. They also, and a lot of that has to do because of the permanent 37% top rate, the SALT deduction that we mentioned. Also, people in the upper 1% there are set to have a substantial benefit from the increase in the estate and gift tax exemption, which had been at about 13 million per individual. And that's been raised to 15 million per individual. So that's how much of the estate, when a person dies, does not get taxed under the estate and gift tax rules. And that was raised from 13 million to 15 million per person. But it's an even greater increase than it looks, because that 13 million exemption was part of the Tax Cut and Jobs Act, and it was set to revert at the end of 2025. It was going to go back down to about $7 million per person. So that's going to be, right there, about another $8 million per person that is exempt from the 40% estate and gift tax. So that's like well over $3 million to people who are in that tax bracket. The one thing that is not beneficial to people in this group is that the OBBBA introduced a new overall cap, limiting the tax benefits of itemized deductions to 35%, which slightly dampens the gains for very high earners. For business owners and investors, there are a lot of advantages, including the 100% bonus depreciation, which has been made permanent. The exclusion for qualified small business stock gains has been raised from 10 million to 15 million, with a shortening of the required holding period. They made permanent the domestic R&D expensing, and they made permanent the interest limitation relief for business owners. And so this is the a chart of the distributional effects of the tax provisions by income percentile. So again, here, this is just the tax provisions, because it's showing the bottom 20% gain about 2%, and that's because of the tax provisions. But of course, this doesn't take into account the spending cuts. Again, after you take that into account, then the bottom 20% is losing about 3% rather than gaining 2%. As a percentile, the people in the 60 to 80th are the best off at 6%. People in the top 5% are gaining about 4% of their income as an advantage from the tax provisions. Although it should be noted that even though this makes it look like a lower amount in terms of actual dollars, since they make so much more in the top 5%, that 4% is actually a lot more in terms of actual dollars than the 6% for people in the 60 to 80th percentile. And finally, here I want to go over a few things that are not from the One Big Beautiful Bill Act. These are continuing changes from the Secure and Secure 2.0 Acts that are of interest to a lot of people. So these are recent changes, some of which are still being phased in to retirement accounts. First thing to go over has to do with the penalty for the failure to take out your required minimum distributions. The old rule prior to 2023 was that if you didn't take out the RMD that you were supposed to take out, if you did not take that out, there was a tax of 50%. So you'd lose half of that anyway, having to pay it to the IRS. It's an excise tax on the amount that you failed to withdraw, and your RMD's the starting age was 72. Under the new rules, the penalty has been dropped from 50% to 25%, and the starting age has risen from 72 to 73, and then it's scheduled to rise again to 75 in 2033. In addition to the reduction in the halving of the penalty, the penalty, the excise tax can be reduced if you correct the error within 2 years. So you find out you should have done this last year or the year before, you can still take out the money, and instead of having to lose 25% of it, you only lose 10%, as long as you make that correction. So this gives you a way out for having realized your mistake and correcting it. And then the other thing is they now have provisions for waiving the penalty entirely for reasonable errors. If you're in a situation where you think that might apply to you, I would highly suggest calling me. The information on how to call me will be part of this presentation that you'll be able to get a copy of later. The other big change has to do with catch-ups for the 401k plans. The maximum contribution limit in 2026 for the general max contribution is 24,500. But since 2001, 401k plan participants 50 or older have been able to contribute catch-up amounts, and for 2026, the general catch-up amount for age 50 plus is 8,000. So instead of 24,500, they can contribute up to 32,500. However, that's beginning in 2025, and so this may be new for you, and if you might see if it applied to you last year or if it may apply to you this coming year. But but now plan participants age 60 to 63 have an even higher catch-up limit. The more recent catch-up limit now is 11,250. So instead of the limit of how much they can contribute being 24,500, if you're age 60 to 63, you can contribute up to 35,750. And then another change from the Secure Act is that beginning in 2025, last year, so 401k plans that were established after 2022 must automatically enroll employees. The starting enrollment rate has to be between 3 and 10%, and it must increase annually by 1% until it reaches between 10 and 15%. It should be noted that this does not mean that you are required to participate. So you can opt out and tell your employer, no, I don't want to be enrolled. This just kind of flips the script on what the rule is if you don't tell your employer. So before, if you didn't tell your employer, then the employer might not sign you up for the program. Now the employer has to sign you up unless you tell the employer not. And then there's now a 10-year rule for taking out all of the withdrawing all of the funds from an IRA that you inherited. So someone died in or after 2020, you must withdraw all of the funds that you inherited by the 10th year following the date of death. There are exceptions to that for if you're the surviving under the exceptions, you can withdraw the money throughout your lifetime, and they have tables there of how, depending upon your age, what percentage you have to take out, so that it's considered to be beyond throughout your lifetime. You fall into these if you're a surviving spouse, um, if you were a child of the person you inherited it from, and you a child under the age of 21, if you are disabled or chronically ill, or if you were close in age to the person that you inherited from by that is, you were not more than 10 years younger than the decedent. And and this is here's the contact information. So if you get a copy of the of this presentation, this is it'll be here at the end of how to call us to set up a consultation with me, or you can email us, and we will set up a consultation as well. And I am ready for some questions.
Right. And yeah, I just dropped that email and phone number in the chat as well. If anybody wants to copy and paste it, it should be the most recent thing there. One person asked Timothy, are you able to, if people do email in, actually send this copy of this presentation to them?
I can, yes.
Okay.
I didn't know if you had a way to do that, but I can, if anybody wants it, they can and send they can email me, and I can send them the presentation as well.
Okay, great. Yeah, we normally will send everybody a recording of the video. So if you want to go back and watch everything, you can do so. Generally on our compliance end for our like Patelco decks, we're not sending them out, but because this is Timothy's deck, if you email him and you want an actual hard copy of this presentation to go back and study, he can get that sent to you as well.
Yes,
A couple questions that popped in just while we have a few minutes here. There were some questions about the no tax on car loan things that we talked about.
Yes.
Predominantly around what was considered a new versus a not new car. So someone was asking about like a leased new vehicle. Someone else was asking about like buying a dealer service loaner car that had low mileage. The dealer, I guess, was always the owner. So where is the line there between what's considered brand new versus what's considered like pre-owned?
Well, brand new means that you're the first person to buy it from the manufacturer. That's simply what new means. The examples that you just gave, however, that's not really under a question about what's new. It's a question about whether you actually bought it. Because if you're leasing it, then a lease is not, you're not paying interest, and you're not, and it's not a loan that is secured by the car. A loan that is secured. So remember, this is interest on a loan that is secured by the car. What is secured by the car means that if you don't pay the loan, they have the legal right to come and hook up a wrecker and grab your car and
Right.
take it away and sell it.
Sure.
So that's what it means. They can take the car if you don't pay the loan. And of course, if you're on a lease, well, if you're on a lease and you don't pay, they can come take it as well. But that's not. But you're not owning the car. If the lease, if whenever you stop paying that, they'll come and take it away. Whereas if it's a loan, then once you pay off the loan, it's yours. And you don't completely, and you don't have to worry about that.
Okay.
So it has to be an actual loan where you own the car. So the situations that you mentioned, you're not the actual owner, so you're not paying interest, and so that doesn't apply.
Sure. Okay, makes sense. Before I ask one last question here, for people who are in the chat are asking specifically about how to get a copy of this presentation, would you like us to direct people to the litc@sfr.org email? Is that the best one to reach out to, or yours specifically?
Yes.
Okay.
That one's probably the best one.
Okay, great. I'm going to drop that in the chat one more time for you guys. So it's the one I just sent, LITC intake line. It has their phone number, and the email is just LITC, Low Income Taxpayer Clinic, @sfbar.org. So that's the email you guys are going to use.
If you just want to call and leave us a message that you'd like it, And with your email, we can do that as well.
Okay, great. And then one last real quick question before we send you on your way. Someone was asking, does the state and local taxes deduction of max $40,000 apply to rental and investment properties or only primary residences?
It only applies to, well, it's not even necessarily primary residences, but it applies to personal properties. So if you're renting out a property or if you're using it you're running a business out of it, you get deductions for that already, but not but not like under Schedule A. You're getting deductions as because it's a business expense. So so you might be paying interest on a mortgage for a property that you're renting out or that you're running your business in, and then you get to take that deduction on your Schedule E, where you're reporting your rental income, or on your Schedule C, where you might be reporting the business income. But that's separate from the state and local tax deduction. And again, the same property taxes as well. So if you're paying property taxes on these properties, and I guess that's more directly related to the question. You're paying property taxes on something that you're renting out or using your business. Yes, those taxes are deductions on your Schedule C if it's a business, or your Schedule E if it's a rental. But what we're talking about here are for personal use, which is on the Schedule A for itemized deductions.
Okay, awesome. Thank you so much, Timothy. Phyllis, thank you for also letting me know that. I put it in the Q&A. I also had my settings set to host and panelist, so I just dropped the phone number and the email again in the chat. This time, make sure everyone can see it. So anybody who is in our chat now, the most recent one, you should be able to see right there. I'll drop it one more time. And just a quick recap, we will be sending an email recording with the YouTube link to this webinar probably sometime next week. So keep your eyes in your inbox for that if you do want to just go back and rewatch all this. Otherwise, like I said, you can reach out to Tim directly. We sent the email and the phone number. So feel free to reach out. They can offer some advice as well. I will be also sending emails on Friday with the 3 $25 Amazon gift card winners, so keep your eyes peeled in your inbox for those. Only the winners will be notified. So if you do get an email that says Patelco Credit Union webinars, you want a $25 gift card, I promise it is not a scam. It is yours truly typing that and sending it your way. So keep your eyes open for that. Like I said, that'll be Friday. The recap email with the recording will be sometime next week. Since a lot of people are saying their thank yous in the chat, I appreciate all you guys joining. I will paste this.
And I'd like to thank you, Andrew, for hosting this, and to Patelco for hosting this. And I'd like to thank everybody who showed up. I am very flattered to have so many people here.
Of course, we appreciate you, Timothy. Every year you give us great information. I know the members really appreciate it as well. So thank you all so much for your time. Sorry we couldn't get to all your questions, but Timothy's great. You can reach out to them with anything additional. Otherwise, we are going to close this out. If you guys would not mind just sticking around for 1 minute to fill out the quick survey when we're done, it would be greatly, greatly appreciated. Otherwise, take care, everyone. Have a great evening, and we will see you again in 2 weeks from now. Have a good one. Hey, you guys, hope you liked that video. Thank you for watching. For more financial wellness information, go ahead and click here to subscribe and here to watch the next video. Thank you.